I'm not a huge seasonality guy, but the ones that make sense to me, like elections and taxes, those things I like to follow because it's just part of human nature. Now, we're going to talk about the Santa Claus rally today, what it is, what it isn't, how we could potentially make money off that. And while we are here, I want to give a huge shout out to the Stock Traders Almanac and Jeff Hirsch. Definitely go pick up your copy if you're interested in looking at seasonality and seasonal behaviors of the market, right? It's just every week you open up, you get a cool couple facts, and you say, this is normally what happens this week if there's something out of the ordinary to take advantage of. And also, go to StatsEdgeTrading.com, trade with a provable edge. We look at the market through a statistical lens. You get access to the output of all of my algorithms, day trading, swing trading, investing, all of that for just $150. It's a really low, really good price there. So go check that out over at StatsEdgeTrading.com. And now we got all that out of the way. Let's get into it. So the Santa Claus rally is not the month of December. I hear this all the time, or it happens after Thanksgiving or something like that. It's not. It is very specifically a period of time, which is the last 5 trading days of the month. This year, it starts on Wednesday, the 24th. So the day right before Christmas. That is the Santa Claus rally beginning. And then it goes to here, which is the 5th of January. And that is the Santa Claus. So it's 24th to the 5th. That is the period of time. Now, why do we care about this period of time? Why is this interesting? Why do you hear the Santa Claus rally talked about so much? Well, because statistically speaking, here are all of the returns, and this ended, I think, 2003, 2002, 2003. I'll move my head out of the way, from 1950 on. And we don't need to study all of them. The point is that there is an unusually long period of time in which you get big rallies around 1.5% to 2% over just this short period of time. And here's just a short-term chart that I put together with perplexity, and it's the same kind of thing. Again, the idea, the numbers, we don't really need to get too nitty-gritty. Most of the time, the large majority of the time, you are up for this period of time. Now, first of all, why? Right? There's a couple ideas that I have about why this could take place, and I don't think any of them are super revolutionary in any ways, but follow the money. So first of all, hedge fund managers are paid by year-end kind of bonuses. So if you get paid 2 and 20, so you get 2% of management fees and generally 20% of performance. So if you make $100 million for your clients, you get $20 million. Generally speaking, that marks year-end performances. So are you really going to want to rock the boat and do some crazy shorting and dump all your stocks or do anything that's going to disturb the market in the last couple of days? Doesn't make sense to me. Also, if you follow the money, tax loss harvesting. So tax loss harvesting is this thing where, say you own 2 stocks. You own NVIDIA, which is rocketing, and then you own AMC, which is just a dumpster fire and always hitting new 52-week lows. At the end of the year, you can sell either NVIDIA, which you have to then sell it and pay the tax man the whole bunch of gains that you make. So against that, you may also sell something like an AMC, because if you are losing money on that, that will harvest some of that tax. So you're no longer paying the full amount. You're now, getting these old junky positions that aren't working out so well off of the books. That can depress stocks that are down on the year and are in downtrends even further going into the end of December. And then usually near the end of December, you're done. And you've done all the selling that you need to sell. And, maybe you're sitting in a bunch of cash, maybe whatever it is. But that kind of inflated selling pressure that happened on the market, that is done and that is lifted. So now if the stock wanted to rise, but there was a hedge fund manager kind of pushing it down, well, it gets to kind of rise on its own. So those two things I think explain most of what's going on with this phenomenon, is that people are looking to do this repositioning. All right, tax, death and taxes. You got to deal with both of them. So people are moving this money around from a tax point of view. Now, also, what it can do is by, selling the things that are down, sometimes they want to do this thing with the raised cash called window dressing. And I'm sure you've heard about it if you watch CNBC all the time. It's essentially, imagine you have to meet with your clients at the end of the year and you don't have any AI plays on the books. You don't have NVIDIA, you don't have Meta, you don't have any of these AI plays on the books. You got a lot of explaining to do, right? These people don't care about valuations, and they might not say, hey, it's probably not the time to buy NVIDIA right now. They don't want to hear that. They want to hear, yes, AI is a big thing and we're participating. Look, we have all these holdings. We may have been a little bit late, but we're in them now. Don't worry. Next year we'll do fine. And this happens every year, and it happens all the time. Whatever hot trend is in play, generally we'll get more buying in. News independent. You'll generally get more buying into whatever's going on. So again, a lot of just factors that make sense when you think about them, because these are the people that move the market and they have these things that they have to do to move around stocks. So it makes perfect sense that you're going to get these movements at the end of the year. And again, it normally happens, and that's good. And maybe there's a trade to be made there. Maybe you want to buy and hold that Santa Claus rally and capture that, 1.5% on the market or some leverage instrument, and have, again, an 80, I think a 75 to 80% chance to make that, which also means 20 to 25% of the time it doesn't happen. And that to me is a little bit more interesting. So, right, it's written in the book. You've probably may have heard the saying before. It's a common one, but if Santa Claus failed to call, then bears will come to Broad Wall, and Broad Wall is where the New York Stock Exchange is. Basically meaning if you don't get a Santa Claus rally, sometimes that is the precursor to a bear market that is coming in the next year. That to me is what I'm looking for more than anything. If I know that 80% of the time during this period of time, you get a nice little push up in stocks. If I know that that's the case, most of the time, things are fine. The times that those things are not fine, that to me is where things get interesting. So I'm watching to see if we get this, and if we do, I just go, okay, business as usual, move on. As someone who owns stocks and is long stocks, I'm obviously rooting for this. But at the same time, I'm looking for if it doesn't happen. Because if it doesn't happen, then there's certain things I will start to dig into the data and say, okay, let's look at all the times that this didn't happen. Let's look at what happened to the market in that period of time. And that's it. That is the Santa Claus rally. That is what we're looking for. Again, I just hear so many people say things like, oh, the market's up all December. And every time you get a down tick in December, they say, oh, look, where's Santa? But no, it's this, again, very specific period of time that does this very specific thing. And if it doesn't, then I think we get some data. If you're interested, again, in more of this content, go to StatsEdgeTrading.com. You can sign up for the free email list there. If you find yourself lost about what to do in the market every day, try trading with a statistical proven edge. We've got over 100 now people that are in the program and they're enjoying it. And I'll be the first one to be honest that it's not a money printing machine that, I'm on a yacht driving a Lambo around a yacht or anything. But I know at the end of today, I will run all of the trades for next week. And then I'll just have I don't need to look every day. I don't need to guess what to do. If the stocks hit the levels, I look at them. And if I like them, I take the trade. If the stocks don't hit the levels, I never see them again because we have a Discord alert bot that will ping you in real time to your watch or your phone or whatever. If you're someone who's out and about, and it'll just ping you and say, hey, this stock hit this price from this algorithm. All of the data of the algorithms up on the website. So you can say, hey, this one's, very interesting. It's looking for pullbacks or mean reversion or whatever. Take the trade if you want to take the trade, put the stop loss, move on with your life. And it is, I'm telling you, a much calmer way to trade. And I highly recommend it. Even though, just like any kind of trading, you're not going to print money all the time. It's calmer, it's more systematic. It's less, what am I buying and for what reason and why am I selling it? We don't think about any of that. If it comes through and we like it, we take the trade. If you're interested in that, again, StatsEdgeTrading.com. Till I talk to you guys next time, get away from the screens.